Welcome to CrushTheStreet.com's weekly market wrap-up. Let's get started in the equity sector, which rang in flat following geopolitical concerns as well as stubborn growth metrics from China and other emerging markets. A common theme this week, which so far has been marked by lackluster performances. The benchmark S&P 500 closed at 1849, down negative 0.19%, with the Dow Jones Industrial Average not faring much better, ending virtually at parity against the prior session. The Nasdaq led the way in terms of losses, shedding slightly more than 0.5% of valuation. One of the breaking stories for this week was the Federal Reserve's rejection of Citigroup's plan to raise its dividend and increase its stock buyback, which would have provided compensation for shareholders whose stock has underperformed. In the past year, Citigroup shares have gained just 13%, while JP Morgan shares were up more than 25%, and Bank of America stock gained over 40%. This marked the second time the Fed has rejected a Citigroup capital plan. Citigroup is also one of the few names on the fail list of the Fed's big bank stress test, a topic of which is sure to come up in the light of its CEO Michael Corbett and his enormous compensation package of $14.3 million, which he explained was a result of improving risk outcomes and controls. This latest setback not only threatens his future at Citi, but also the stability of their management team, where Corbett only recently replaced the former chief executive, Vikram Pandit, some 18 months ago. The tragic irony in this banking cartel drama is that these so-called stress tests are completely irrelevant unless the Fed also subjects itself to such a test. Since central banks across the democratized world are responsible for directing monetary policy, adjusting liquidity flow against economic conditions, it's only logical that a car's engine be checked before worrying about auxiliary concerns such as tire pressure. With the vast and unprecedented scope of monetary intervention that the Fed executed in order to combat the 2007 recession and the shock deflationary collapse 1 year later, its balance sheet has tripled in size. Worse, the full spectrum attacks on the yield curve has led to a compositional risk that has extremely serious repercussions should the Fed fail the delicate balancing act it pushed itself in. This and other reasons are why alternative asset investors, who may be taking hits in gold, silver, or even Bitcoin now, may just become the last ones laughing. With so many fundamental hotspots that can easily erupt overnight, combined with the fact that the Fed is deliberately attempting to divert eyes away from the real problem, there seems to be little sense in holding 100% of your money in the clutches of the current financial paradigm. Whether this be your 401k, an IRA, or God forbid, the new Obama retirement mandate, the MIRA, which apparently combines the savings ethic of a capitalist system with the money flow of a socialist system. Otherwise known as you pay, they play. And that'll do it for today's edition. Thanks for watching, and we'll see you next week.